So one of the most commonly used phrases amongst financial planners and YouTubers is
asset allocation.
Asset allocation.
Asset allocation.
Asset allocation.
What is asset allocation?
Asset allocation.
That's right, asset allocation. And in a nutshell, it's the process of diversifying one's investment portfolio across different asset classes like stocks, bonds, real estate, gold, etc.
That's it?
Well, there is more to it, and in this video, I shall be taking you through 5 different asset allocation methods, with each of these serving a different objective, a different persona of investors, and of course, a slightly different methodology. But let's start with the definition itself, and there are 2 words I want you to focus on. The first is process, and whichever asset allocation technique you employ, it is very important to follow a series of steps, a system to derive the maximum advantage of it. What advantage? Well, in a sentence, asset allocation aims to present investors with a better, a higher risk-adjusted return. Samajh nahi aaya na? So let's understand this with a simple business school 101 graph. So on the x-axis, we have the risk, and on the y-axis, we plot the returns. Traditionally, return and risk are positively correlated, and by that logic, we can plot multiple points anywhere on this graph. Now, the purpose of asset allocation is to improve the return-risk equation, which means graphically, this portfolio should either aim to achieve a higher return for the same level of risk or achieve the same level of returns but at a lower portfolio risk. In other words, asset allocation helps you move from a high to a high-medium, or you move from a low to a medium-low. Both these scenarios represent an improvement in your risk-adjusted portfolio return, which is the true goal of doing asset allocation. The second important word in our definition is diversify. Now, diversify does not really mean having different assets, but what it actually means is having diversified assets. Let me explain this with some data. So say one instrument you really like is a Nifty 50 index fund, which is a large cap fund. And for the purpose of diversification, you opt for a mid-cap fund, let's say the Nifty Mid-Cap 150 Index. Now, when I plot the performance, observe how tightly correlated the performance of the Nifty 50 and the Mid-Cap 150 is over long periods of time, which essentially means a portfolio that consists of only the Nifty 50 and the Mid-Cap 150 does not really serve our asset allocation goals, although it might have other advantages. Now, when I layer the performance of gold over the same graph, you'll start seeing a pattern, and you'll notice how divergent the performance of gold is as compared to the 2 equity indices. This is what we really mean by diversification, that is, the use of asset classes that are negatively or at least weakly correlated to each other in terms of performance. So to sum this up, good asset allocation is a process-driven approach. It makes use of diversified assets, and the primary goal is to improve the portfolio's risk-adjusted return. The first approach to asset allocation is age-based, that is, how much of the portfolio should be allocated to equities is decided as per the investor's age. In fact, in my video on 10 investing thumb rules, I had presented this very point under the 100 minus age rule. So as an example, and since I'm 43 years old, the age-based asset allocation strategy requires me to keep 57%, that is 100 minus 43. So I have to keep 57% in equity, and the balance 43% would go into non-equity instruments like bonds, debt funds, gold, real estate, etc. While this approach is a start, in my view, it is neither scientific nor a recommended one, as it does not factor important variables like investment goals and the person's risk profile. And that's where strategic asset allocation comes in. And as a concept, it involves dividing an investment portfolio amongst different asset classes based on 6 different criteria. The first criteria is age, and generally, if you are young, you should have a larger part of your wealth in equities, and as you get older, you move into other asset classes like bonds, real estate, and gold. The second element is the time horizon, and while longer goals can support the more riskier assets, one should use more sedate instruments like a fixed deposit or even a savings account for short-term goals. Then comes your financial goals, and because everyone has multiple goals, it's often recommended to not look at asset allocation as one single large box, but to break it down into smaller boxes on the basis of the goal you are chasing. For example, your retirement goal, which is probably 30 years away, should have a different mix of asset classes as compared to your 4-year goal of accumulating enough capital to start your own business. The fourth and final factors revolve around the number of dependents and the income stability. And the more dependents one has, or if the income is inconsistent, the more difficult it is in terms of the planning process. The sixth and final factor in strategic asset allocation is the risk profile. And because everyone has their own perspective, their own trade-offs when it comes to risk and return, for the sake of discussion, here's how I look at it, especially when it comes to the goal of wealth creation. So when I had less wealth, let's say when I had 15, maybe 20 lakhs, so at that time my risk profile was not aggressive at all. In fact, I would say it was very moderate, and I was relatively happy if I had beaten inflation without having to take massive risks. But as I crossed a certain threshold, let's say 50 lakhs, I observed that I was more willing and I could take a little more risk on the incremental money. And again, when my portfolio crossed a crore, I could be a little more audacious and so on. The point is, I think no one has an innate risk profile, something like मैं तो पैदाइशी conservative who. No, I don't think that's right. In fact, I think it's the circumstances, that is your corpus, your age, dependence, goal, income, etc. And it's all these factors that come together and make up the risk profile. So anyways, these 6 factors I have presented here is what converges into a strategic asset allocation strategy. And if done well, it not only improves your risk adjusted returns, but it also makes the financial side of your life a lot more peaceful. The third approach to asset allocation, which I daily follow, is called the core satellite asset allocation method. So as the name suggests, this approach involves dividing one's portfolio into a core holding which has broadly diversified investments and a satellite holding which has more focused investments. For example, my core, which is about 80% of my portfolio, follows a clear and comfortable setup of equities, gold and debt, which I've already explained in a previous video. I think you can access it by clicking on the I button somewhere on the screen above. So this core portfolio is designed to provide stability, to reduce portfolio risk, and it generally gives me around 11.5 to 12% per annum. It's my balanced 20% that goes into a satellite portfolio that I use to generate high returns. This portfolio includes many of the experiments I do and a few high conviction stocks which I track and review periodically. As expected, the satellite portfolio is, and I won't use the word risky, but I would say it's a bit more volatile, with a few stocks falling by 30% from my purchase price, while some others have doubled, even tripled in value over the last 2 years. So lots of ups and downs, but personally, my own experience of having a core portfolio and a satellite one has been really beneficial to me. This next type is a risk-based asset allocation strategy, which is essentially the matching of the investor's risk profile with a bouquet of asset classes, each of which have a return and risk level of their own. Let me explain this with an example. So all investors, including you and me, can be boxed into one of these 5 categories: conservative, income, balanced investor, growth, or an aggressive investor. Now, each of these 5 personalities represent a certain level of volatility that one can take in his or her portfolio, with conservative and aggressive investors at the opposite ends of the risk-return spectrum. The next step is to assign a certain fixed percentage of every asset class to each of the 5 risk profiles. For instance, the suggested long-term asset allocation for a conservative investor is 10% in equities, 80% in bonds, and the rest 10% goes into gold. And as the risk profile changes from conservative to income to balanced to growth to aggressive, the proportion of equities will continue to rise while the debt levels decrease. Now, obviously, one can do a number of combinations here, not just in terms of the allocation percentage, but also in terms of assets, wherein one can easily mix and add international equities, REITs, money market instruments, and even cryptocurrencies. But I'll keep it simple here, and to equip me with a data study, I'll be using the Nifty 50 TRI for equities, the Nifty 5-year benchmark GSEC index for debt, and the domestic price of gold as my investable securities. So here's what I did. I pulled out the last 16 years of data from these 3 instruments from websites like niftyindices.com and investing.com. I calculated the annual returns for each of these asset classes, and presently there were many years of negative correlation between equities and bonds, and even equities and gold, which is good from a diversification standpoint. I then populated this data over our 5 risk profiles, which helped me calculate the returns that a conservative, income, balanced growth, and an aggressive investor should have achieved. I did this by applying the weights we had discussed earlier, and here's what it came to on an year-on-year basis. Now I won't get into the data too much, but notice here how the variability in performance increases as we move from a conservative to an aggressive risk profile, something that's also numerically substantiated with the standard deviation. Also notice our conservative portfolio hasn't had a single negative year since 2007, which at a pre-tax return of 8.6% is not only a tad higher than what our fixed deposits would have been giving us, but on a post-tax basis, it is substantially higher given the fact that long-term capital on debt instruments has a much favorable tax treatment as compared to FDs. One last but very important observation here is around returns. Now I've inserted the performance of our three asset classes in isolation, and what's interesting to note is that had we not done asset allocation and had put the entire fate of our portfolio on, say, the Nifty 50 index, then it would have delivered somewhere close to what a balanced investor would have achieved in these 16 years. On the other hand, a portfolio with just 60% in equities and the balance in debt and gold would have done better than a 100% equity portfolio, and that too at a much lower level of volatility. If you connect back with what I had said earlier in the video, the true goal of asset allocation is to improve one's risk-adjusted return, and this table really proves that, with the investor not only generating higher returns from a multi-asset portfolio, but he or she did that by taking a significantly lower level of risk. If you're getting good value from this video, then please do give this video a thumbs up. And if you aren't a subscriber yet, then do consider becoming one, as I can then serve you videos as soon as they are released, and also share with you some investing strategies, tips and stories that I continually post in the community section. The fifth and final type is dynamic asset allocation, and as an approach it involves making changes to one's asset allocation based on a set of predefined rules or algorithms. For example, and we discussed at length about smart SIPs and alpha SIPs, so mutual fund companies and fintechs use the stock market's valuation levels as an additional intelligence layer to determine if one should be buying more units or redeeming units, or if they should merely hold on to them. A dynamic asset allocation model does something similar, but it does that over multiple assets, often shifting some part of the money from equity to debt, to gold, back to equity, etc., thereby maintaining a balance between return and risk. Actually, a good way of understanding this is by examining one of the bigger funds in the category, the ICICI Prudential Balance Advantage Fund. This table here shows how this fund's dynamic asset allocation model hopped and skipped between equity and non-equity assets in the year 2020 as the stock markets went from high to low to high in that frantic year. So correspondingly, this balance advantage fund made the required asset allocation changes, often giving a higher allocation to equities when the stock market was depressed, and then pulling back in the months when valuations were reaching all-time highs. I should mention here that this dynamic asset allocation strategy is not just limited to asset classes, as we see in balanced advantage and multi-asset funds, but it also involves funds that cater to certain risk profiles like conservative, moderate, aggressive, etc. And it also has a level of dynamicity wherein riskier assets are toned down towards more safer assets, like what we see in the management of our NPS portfolio. Now you might also come across a term that's labeled tactical asset allocation, which simply said requires making frequent adjustments to a portfolio's asset allocation based on market opportunities and economic conditions. This might sound a bit similar to dynamic asset allocation, and it probably is. But just to clarify, the dynamic style is a lot more strategic, model-based and long-term, while tactical is short-term in nature. While the dynamic style is a lot more passive, tactical asset allocation requires a much higher level of active management. And thirdly, tactical asset allocation uses a far greater number of variables in its modeling, variables like interest rates, valuation, inflation, geopolitical events, market trends, etc. So read up a bit more about it if you can, and to help out, I have added a few useful resources in this video's description. My own approach to asset allocation has been a mix of the techniques that we have studied in this video. And it makes sense, right? You want to pick up the best parts and create a custom asset allocation strategy for yourself rather than picking something off the shelf which has probably been made for someone else. So spend some time on dividing your different goals into separate asset allocation strategies, on choosing diverse assets with low correlation, on finding a sweet spot on how much percentage you want to allocate per asset, and most importantly to periodic monitoring and make adjustments from time to time to ensure your portfolio's actual performance is within reach of your goals. So give it a try, and if you have questions, then do let me know in the comments box. Do like this video, do share it with your friends who need it, and I'll see you 3 days from now. Until then.